Welcome, investors and curious minds. Are you tired of feeling lost in the stock market jungle and not knowing which way to turn? Well, have no fear, because today we're going to take a journey through A Random Walk Down Wall Street by Burton Malkiel. Now, you may be wondering, who is Burton Malkiel? Well, let me tell you, this guy knows his stuff. He's a Princeton economist, a former dean of the Yale School of Management, and one of the leading experts on the stock market. And in this book, he shares with us his wisdom and insights on how to navigate the stock market like a pro. But before we dive into the nitty-gritty of it all, let me give you a little preview of what we're going to cover. We'll be discussing the efficient market hypothesis, the pros and cons of active and passive investment strategies, the importance of diversification, and how behavioral finance plays a role in the stock market. So grab a pen and paper, because you're going to want to take notes on this one. Let's start our journey and learn how to make our money work for us. The efficient market hypothesis. Are you ready to dive into the world of the efficient market hypothesis? Well, buckle up, because this is where things start to get really interesting. The efficient market hypothesis, EMA, is the idea that the stock market is efficient and that it's impossible to consistently beat the market through active investment strategy. In other words, the market already takes into account all relevant information, and therefore it's impossible to predict future stock prices. Now, I know what you might be thinking. Wait, what? So you're saying I can't make a killing in the stock market? Well, not exactly. Malkiel argues that while it's true that you can't consistently beat the market, you can still make a solid return by using passive investment strategies such as index funds. The implications of the EMA for investors are huge. It means that trying to time the market or pick individual stocks is a losing game. Instead, Malkiel suggests that investors should focus on diversifying their portfolio and investing in low-cost index funds that track the market. So, the next time you hear someone claiming they have a secret formula to beat the market, just remember the efficient market hypothesis and the wise words of Burton Malkiel. Stay diversified and keep it simple. That's the key to success in the stock market. Active Vs, passive investment strategies. Are you ready to learn about the battle of the investment strategies? On one side, we have active investment strategies, and on the other, passive investment strategies. Which one will come out on top? Active investment strategies involve picking individual stocks, trying to time the market, and making frequent trades in hopes of beating the market. On the other hand, passive investment strategies involve investing in index funds, which track the market, and making fewer trades. Malkiel argues that passive investment strategies are more effective than active strategies. He states that most active investors underperform the market because they are not able to predict future stock prices, and they also have higher fees associated with their investments. Passive investment strategies, on the other hand, have lower fees and do not require trying to predict the market. They also provide a way to diversify your portfolio and make consistent returns over the long term. So, the next time you're trying to decide between an active or passive investment strategy, remember what Malkiel has to say. Keep things simple and go with the passive strategy. It may not be as exciting, but it will be more effective in the long run. The importance of diversification. Are you ready to learn the magic of diversification? It may not sound like the most thrilling topic, but trust me, it's a game changer when it comes to investing. Diversification is the process of spreading your money across different types of investments, such as stocks, bonds, and real estate, to reduce your risk. By diversifying your portfolio, you're spreading out your risk so that if one investment doesn't do well, the others may pick up the slack. Malkiel emphasizes the importance of diversification in his book. He argues that investors should not put all their eggs in one basket and instead spread their investments across different asset classes and sectors. The benefits of diversification are numerous. It not only reduces your risk, but it also increases your chances of making a solid return over the long term. It's a simple concept, but it's one that can make a big difference in your investment journey. So, the next time you're thinking about putting all your money in that hot new stock, remember the importance of diversification. Spread your risk and increase your chances of success. Behavioral finance. We'll get to that in a second. I have a favor to ask of you. If you like this video so far, please subscribe to the channel, Are you ready to explore the fascinating world of behavioral finance? This field combines psychology and economics to understand why people make certain financial decisions. And let me tell you, it's a real eye-opener. Malkiel incorporates behavioral finance into his investment strategy, recognizing that people are not always rational when it comes to money. He argues that investors can fall victim to cognitive biases such as herd mentality and overconfidence, which can lead to poor investment decisions. For example, investors may be more likely to invest in a stock that has been going up in price because they think it will continue to go up. This is called the recency bias, and it can lead to buying high and selling low, which is the opposite of what you want to do as an investor. Malkiel also mentions other behavioral biases like overconfidence bias, where investors overestimate their ability to predict the stock market. He suggests that investors should be aware of these biases and try to make decisions based on facts and not emotion. So, the next time you're about to make an investment decision, take a step back and think about the psychological factors that might be influencing your choice. By understanding behavioral finance, you can make better decisions and avoid common mistakes. Well, congratulations! We've made it to the end of our journey through A Random Walk Down Wall Street by Burton Malkiel. I hope you've enjoyed it as much as I have and learned something valuable along the way. To recap, we've discussed the efficient market hypothesis, the pros and cons of active and passive investment strategies, the importance of diversification, and how behavioral finance plays a role in the stock market. Malkiel's book is a classic, and it's definitely worth reading. His wisdom and insights can help guide you on your investment journey and set you up for success. Remember, the key takeaways from the book are to focus on passive investment strategies, diversify your portfolio, and be aware of behavioral biases that might affect your decision-making. I hope this video has been helpful and informative. As always, it's important to do your own research and make decisions that are right for you. And if you liked this video, don't forget to give it a thumbs up and subscribe for more content like this. Thank you for joining me on this journey, and I hope to see you soon for more financial adventures.